how can we say things? How can we use our voices for good?
Good morning and welcome to Recipe for Success. Thank you so much for joining me today. You'll notice things look a little bit different. Instead of 2 giant heads, we have 3. So we're going to have a lot of fun today. These two, get your head back. Okay. These two happen to be a couple of my favorite people in the industry. So this is extra special for me. I don't know how you're looking at it. On the outside, in the middle, let's start in the middle. In the middle, we have Aaron Witwer. He is the president and senior benefits advisor at Ben Engage, which is a subsidiary of Revolution Benefits Group. He specializes in value-based medical plan design, including utilizing captive solutions, our topic today. On his right, as I'm looking at the screen, we have Dale Sagen. He is the vice president and business development leader for QBE Accident. He specializes in medical stop-loss captive solutions for employers and their advisors. Okay, so before we get started, are you guys both Eagle Scouts?
No, my daughter's a Girl Scout, though.
Dale, I thought I had you pegged for an Eagle Scout a mile away. I saw in Aaron's bio that he was an Eagle Scout, and I'm like, well, for sure, Dale's got to be an Eagle Scout too, so... No, you really let me down with that one.
I was really busy with video games when I was growing up. I didn't mess with any of that Eagle Scout stuff.
Okay, well, at least we have one Eagle Scout to save us in case one of us starts choking, even though we're not all in the same room. No. So before we get started, I've given your, high-level titles, but I would like each of you to just give a 30-second intro of yourselves and why you're interested in captives. And Aaron, we will start with you.
Okay. Well, I think that intro was plenty about kind of what I do every day, but maybe it's important to frame that for folks that I started in healthcare, treating patients in sports medicine, rehab. So the patient care drove me into wanting to be more preventive. That's how I got into health insurance, sort of recruited to come in. Oh, you can be our health management guy, like the guy that talks to our clients and at the insurance brokerage firm about healthcare. And I realized those were not meshing well. So all my perspective comes from better healthcare somehow, some way. And we just have to do better. So I have a ton of hope that we will, and that we are trending in the right directions. But that's where all my strategies, why I do everything, that's where it comes from.
Dale?
I'll start with a little story here. I was a data analytics advisor, I guess best way to put it, with a consulting firm. And I was working with Aaron actually at the time at this consulting firm. So that's how we met. And I was the data geek. Aaron was the population health management specialist. And we had a captive program that we were working on. It was performing very well. Really intrigued with the fact that everything was transparent in terms of the costs of this program. It was returning underwriting profit back to the employers. It was something that the advisor could brand and use to go after clients and really specialize in a certain industry. And I just thought it was the bee's knees. I really was hook, line, sink at that point. I then became an account executive for a consulting firm, and I wanted to build my own captive program where I had one underwriter, one renewal, my favorite third-party administrator, my favorite PBMs. And ultimately, I wasn't able to get that done at that advisor for various reasons. But I said, I need to figure this space out. So I went as deep as I could in the captive insurance space to try to learn as much as I could to then bring it back to advisors.
Okay, so we're throwing this word of captive around like people know what we're talking about. Now, I promise you all that we don't have any tidy up in the back room. There's no ransom notes, but who wants to take a very elementary description of what a captive is for somebody that does not know?
I feel like that's my job, Aaron.
I think you should. My answer would be more elementary because I am not the captive expert, but let's see if you can do it.
Yeah, I think the best way to put it, and there's a lot of individuals that say it like this, is that it's a private insurance company. It's just your own regulated insurance entity. You are finding your favorite reinsurance partners. You are building out the structure of the amount of risk that you would like to take in your captive, but it's you and your favorite people just banding together to just make it look and feel like it's a large employer that you are really negotiating around the market with for anything you want.
Aaron, how do you do?
Yeah, I mean, I've even said it even more simple than that, but that is, I mean, when I've started to talk to advisors about this. If you're already using the same couple TPAs, PBMs, and stop loss carriers, you've basically created your own health insurance plan anyway. And the captive is a way to put all of that risk together and let us all band together. And I think that's important for small groups in particular. You know, large employers and jumbo employers already do all this. They already put all this risk together. But that's how I describe it. Like you already kind of have the captive philosophy down. Now let's really ramp this up and actually take in your own cell and go into stop loss 201 and 301 level, you know, education, which is what Dale's done for me.
Okay. So what makes a captive different from regular self-insurance or level funding?
Yeah. So when you are self-funded, you're essentially saying, I am in charge of all of those claims that can materialize, right? And you buy stop loss protection from a risk partner that you feel confident in. And it's typically just a black and white transaction. You take on that premium, pay me claims when it materializes. I'll share with you that, you know, that proposition is a for-profit proposition typically. The underwriter, the insurance company, is really just trying their best to be competitive. They are looking for, you know, their manual to tell them where the rate should be, your claims experience, or if you don't have any claims experience, just, you know, trying to find that edge just to be competitive. And, you know, quite honestly, it's not designed to just reduce the cost drastically. It's really a proposition typically with stop loss and traditional self-funding where you're going to pay a little bit more for that stop loss. Well, employers eventually see that it's just not efficient. And a lot of times I'm just being told no by the stop loss carriers. And here's the price point compared to fully insured. I should just stay fully insured. Well, what the captive does is it essentially creates a buffer. It creates a gray area where if the claims don't materialize, then the underwriting surplus is returned back to the employers, or whoever set up the captive could take a layer of risk as well. But, you know, we'll avoid captive 301 for the moment. Now, what you're doing is you're essentially saying, I believe my risk management strategies are going to outperform the general market. So I'm going to have my clients just pay a little bit more reserves, collateral, capital, whatever you want to call it, for the opportunity when my strategies pay off. They're going to reduce their costs even further. And then the flywheel starts at that point.
Okay, I'm going to try. Well, let's going to see how tricky I am. It's very doubtful, but I'm going to try and put a slide up here because this was out of. I think this is a good visual. So let's see how we. Oh, look at me, I'm pretty good. So who would like to go through this little visual? Because I think this one is really helpful.
I'm happy to do the play-by-play. Aaron, add your color commentary along the way. The visual is nice because it shows that the employer is retaining risk within their self-funded health plan, right? It is self-funding. It's not an insurance company. It's contracted with the ERISA rules. Everybody gets that. What you ultimately do is you are transferring risk to somebody to make sure that there's a buffer in place to protect in case a no good, very bad day happens for one employee, or there's just a zombie apocalypse and then everybody is walking around just really struggling with their health care. You want to put that cap on your health plan, that purple layer. But what I'm here to tell you is that a lot of solutions in the marketplace can actually impact catastrophic risk. Instead of actually just paying the insurance company for those claims that are going to pop up for oncology or musculoskeletal conditions, or, you know, some of these drugs, these specialty drugs, if you can find alternative solutions for it, instead of paying insurance for that, let's just budget for those losses. And if we can actually be successful in managing those down in that green layer that everybody is sharing risk in, now we've lowered the cost for those employees because the claims did not materialize. So that's the value of captive insurance in one visual.
Okay, so I'm an employer and my job is making widgets. Running a captive sounds really complicated and not my job.
Yeah.
Aaron,
Yeah.
how do we overcome that objection?
Yeah. When I talk to them about the health plan, as I start to understand how much they know about their own health plan and how health plans work and how they have stop loss already and what's that mean. I remind them that especially if they've been in self-funding for a while, if they've quoted a bunch of different plans, they may have already been in a captive and not even known it. And I think a lot of advisors sort of find out as they're quoting or after, like, oh, I didn't even realize this health plan I'm quoting already is part of a captive. And so oftentimes it's really a moot point. By the way, you're going to be a part of a captive. This is what it means, but you don't need to pony up any extra money. However, if we want to do more of a pure captive, the difference will be, employer, you will put up some money. It's called collateral. And it's not actual like 10 grand or 20 grand of cash that you have to divvy out, but you got to hold on to it. And that can be a letter of credit even. But what that means is you're sort of taking part in the risk, meaning you understand what's happening and saying, I trust all these solutions that Aaron is putting in place. How am I not going to get Rinvoq medication for 10 grand, but instead get it for 2 grand? And I know I'm going to do that over and over and over. So I'm not really worried about having an increase next year or hitting my ag or anything. So yeah, I'll take a little risk, and I know I'm going to get all of it back plus more. And just that conceptually usually alleviates most of their concerns. Now, of course, they have other questions about what the collateral really means. Do I actually have to put up that cash? And I just want to make sure, and where does it sit in the budget, in my banking account and some of that. But technically speaking, we're still just buying stop loss.
So aren't there some medical captives that actually do require a check for the collateral and hold on to it?
Well, yeah, I would say there's always a reserve that should be posted by somebody. Now, there's some circumstances where the sponsor is the one posting that collateral or the capital, so they earn the reward, right? So the employer doesn't even know that there's a captive in place in a lot of agency captive programs that are popping up more and more these days. But, I wanted to add this little color commentary as well is, the employer that focuses on their widgets, they're not here to manage an insurance company and invest in an insurance company. And like, that just seems extremely terrible for them in their mind. Like, why would I want to manage this thing and own it? So there's a lot of really quality programs out there. QBE is actually underwriting a lot of these where there's somebody that has their favorite risk management strategy. They've built this insurance program. Yes, the employers post a little collateral. The stop loss is more efficient, but it's something where the employer doesn't have to become an owner of the insurance company. They're just partaking in some of that risk.
Yeah. This is the other, on the last three groups that I put in there, what's really resonated with them not getting too wrapped up in the technicalities, but certainly understanding it is, I philosophically understand why I'm going to go in and share this risk with these other like-minded employers. And they liked that. If they don't, for whatever reason, like it, doesn't make sense, we just move on. And so it doesn't have to be for everybody, but I think that's important. And if we do a good job with this in this movement of cost containment and helping employers actually be able to afford to offer health insurance, then we'll have more like-minded employers say, I get it. I get that I'm going to be in there with other employers like me, and I might as well share risk if I know they're going to contain their costs the way I do, and they're going to care about their employers the way I do. Then sure, I don't feel like this is a risky endeavor at all to go in on this together. And by the way, if the other group takes a dump, it's not like, I'm going to have to pay for their renewal per se. I just get the majority of the upside.
Okay. So, since Dale was giving us a little QBE commercial, I'm going to give you a little more airtime here because I actually found this on an article that you shared with me, and it says the top 5 reasons to choose a captive, which I actually thought was a really good list and makes a lot of sense. Reduce frictional cost reduction, enhanced risk management and long-term stability. Who doesn't want that? Customization and flexibility for employers, efficient financial utilization and dividend returns, leverage with carriers and service providers. Okay, so okay, that's weird. Looks like it didn't go live on LinkedIn. Boy, that's interesting. Hey, LinkedIn. I guess the rest of us will be viewing it on YouTube. I'll repost this. Wondered what was going on there. So I'd like to address some of those points. Who wants to take which one?
Oh, Dale, you should go.
Yeah, I'll jump in. Yeah, ultimately, number one reason why captive insurance is in place, I mean, from the PNC side as well, is the control. You now have something that you can leverage against the market. When you are negotiating with the insurance companies, the commercial insurers out there, you're taking on some risk and you are flagging to them that I care about this risk now. It's something that I am going to plug in my favorite risk management solutions that I know are going to be impactful. So I'm going to take this layer of risk and I'm going to sell you the top end risk. I want you to still be my partner in this, but it's not just a black and white transaction. Like I said before, now it's I have more control over my future, especially when I'm banding a lot of employers together. I can negotiate a better PBM deal, a better TPA deal, a better nurse navigation opportunity for these employers. And quite honestly, Nancy, make the advisor's role a little bit easier because now you're working with just one set of specialists instead of an entire market of solutions out there.
Okay, so what about plan design? Do all the employers have to have the exact same plan?
It's up to you. Every captive is different. There are some that say you have to have the exact same plan, to be honest with you, but there are some that say, look, that's really up to the advisor and the employers. You pick and choose what you would like, and we're just going to underwrite it for you.
Yeah.
Okay, go ahead.
Okay, no. Go ahead.
So since we're talking about that, you two just happened to work together to put together a very unique captive. Let's talk about what you're trying to do with the captive that you built.
Okay, cool. All right. That was going to lead me into kind of what I was going to say anyway, is the way I've come at this is realizing that some of the other captive options out there that I had explored had a lot of rules, had a lot of restrictions, including like not being able to take my surplus with me, trapping me for long-term contracts, things that in our world of trying to be rebels in this space and have a movement proceed in cost containment, like I can't have all of that. That could work for some, but I could not have that. So I needed just a stop loss carrier that understood captives, that was going to allow me to move freely and build this captive cell the way I needed it to. And how that feels then is like the employees and advisors, the employers and the advisors can come and go, right? They're not trapped. They take their surplus with them at the end of the year. There's no rules yet. And I don't see there needing to be rules, but to answer your question, what we could collectively decide is if Nancy, you and I had clients in this thing, we could decide, well, if we're going to let these other knuckleheads in, like we need to help, like make sure they do some things right.
Right.
So you can't just bring whatever PBM you want. You got to use a select few that we trust and know how to contain cost. But if you want to change your deductibles and copays to be the way you like it, because it's super low or particularly maybe not high, but super low, yeah, that's not going to throw us off. That's not going to change underwriting drastically anyway. And if that's how you like it, we should allow the advisors to have that freedom because they're going to have clients all over the country that have cultural differences. And so what might feel like a great idea at zero deductible for some might feel not like a good idea for others. And that's not going to drastically change the outcome of the captive. So that's what I tried to build.
So I'm not throwing anybody under the bus here, but the captives that we most know, we most hear about in this industry are ones like Pareto and Roundstone. But they're not really doing anything different other than their clients get to go to the Bahamas once a year. So, again, what are you guys doing in your program to contain costs to make this a more attractive long-term solution?
Yeah. So the way I want Dale to answer a little bit about that too, but the way I have talked about it with advisors is the way we're going to control cost is by using plan partners that we trust. So I'll name a couple names just because they've been really good partners, but like a TPA like Coastal Administrative Services and a PBM like TrueScripts have been great. They know what they're doing. I can work with them, and then I can be flexible to build the self-funded plan the way I like it. And I'm sort of like rebundling a health plan for myself. And I know that's going to help me contain my cost. Other advisors have either said to me, well, if you have something you like, just quote it. Or they've said, well, I really like this other regional TPA and another PBM, True RX or something that they've used before, which are also understand it. That to me is got to be, that's flexibility. That's fine, because we're going to be able to contain costs in the same ways. We're going to reduce the high hitters with some nurse navigation, some concierge. That's what's going to really control our cost. Otherwise, I want the advisors to have a little, to my point before, a little bit of autonomy to build these plans the way they would really like. We just can't scattershot. And so I just am not, it's not been appealing to me to go into something that's super packaged, that it's going to limit my ability to have surplus, not let me leave after a year, or have limitations, use a TPM not familiar with. But at the same time, that can be an option for others, I'm sure, especially if you got a difficult client that just really needs something and you're just trying to look for that good quote. It's going to give you some transparency. I mean, we've probably all put our groups on plans that we don't love, but it's a fine fit for them at that stage. Like it's just part of the job too. So I just need one that's a little more flexible and will move us forward, right? So the captive is what's been this very autonomous captive, right? That frankly, and I jokingly say this to Dale, but like I built it in a way so that if QB is not doing a good job, I can boot them and someone else. But the clients don't change. Like we stay in our cell. So we have still leverage over the stop loss, where it's not like, well, forget it. Everybody's got to leave and go find something else. Oh no, we're going to keep at this if QB didn't do a good job. And, as we get bigger, we'll have more leverage with more advisors and more lives in there.
Anything you wanted to add to that particular subject, Dale?
Yeah, I just real quick, we do have 28 captive programs we're supporting, so it's not like we have no experience with this. But one thing I do want to at least touch upon is that a lot of times I talk with advisors that will tell me, and Nancy, you and I had a conversation, this employer has 0 large claims. Why on earth is my number this high when it comes to the stop loss premium? It's just pretty clear that this is really good risk, but nobody's going after this risk. They keep the number up here. That's where captive insurance makes a lot of sense. When you have a stack of solutions that you believe in, Aaron can bring some things to the table and really plug in. That's really one of the things that Aaron does best, is just putting together those puzzle pieces. But at the end of the day, if you've got a cost containment solution that is going to outperform the market, captive insurance is 100% made for you. And we just made it easier for you to come in and start to utilize. And I'll share this. I mean, this might be late breaking news on LinkedIn, but in the captive program that Aaron's referencing, there's 0 claims through May 15th. So at this point, feeling really good that these cost containment solutions are working, and this can drastically reduce the cost of stop loss for them. Now the underwriter's excited. Now the market's getting excited about this. That's the value of this. And it kind of breaks out of the mold of that usual black and white transaction.
So, okay, you brought up a couple of really good points there. Yes, I did speak to you about one of my specific clients, and it's a group of, 150, let's just say that for round numbers, employees. So not big, not small, just kind of, a little above small. And they've been self-funded for about 5 years, and the stop loss carrier has made over $1 million on them. Net. And they wanted to give a rate increase this year. And so we had a pretty in-depth conversation about what it would have looked like if they had been in a captive, and we will continue that conversation as we move forward to next year. I'm sure that they're going to be ready to make that change, but it is it's actually quite frightening to me how much money and profit is in self-funding. So we pretend that it's we're just stripping away all the extra layers of cost. Well, let me tell you, that is just not freaking true.
Yeah.
Those stop loss carriers are making so much money.
Yep.
So much money, and nobody looks at it. Nobody says anything. They don't have any minimum loss ratios. They're not playing by ACA rules. They're like, I'll take as much as I can get. Give it all to me. And by the way, we'd like an increase this year.
And MGUs
we know
too.
we haven't paid. Yeah.
And another middleman in there that, by the way, have their absolute use. But there's all sorts of layers you can have in on these plans that are more packaged plans that you got to be really aware of as an advisor. How many layers of other people are in here, and us as advisors being one of them.
Yes.
But how many others do absolutely need to be in this thing? But Oh, there's plenty of ways to make money on a self-funded plan.
Oh, it's actually insane to me. Once I started looking at it, I'm like, I'm not paid nearly enough. That was my
Yeah, right?
that was my conclusion when looking at it. I'm like, I need to be making more money.
Yeah.
But I mean, but if we get back to it, insurance is the law of large numbers. So the insurance company should not pay out equal to what was paid in. Like that's not how it's supposed to work. Everybody, a large group of people come together and put in a small amount of money to protect against a large unforeseen catastrophic claim. That's what stop loss is supposed to do.
Yep.
And for the most part, it does. Unfortunately, it seems to me that over the years, because there's so little, I hate to say this, regulation around it or actual eyes on it, it just keeps getting more and more and more expensive.
Yes.
But they're not paying out more claims.
No.
Well, let's talk about that real quick.
So let me just say something, and I want you to answer this, Dale, too. I want you to talk about this. Now, and that's actually probably even a better answer to the question that you asked me earlier is why would a group want to do this? Why would an advisor want to do this? You'll have ultimate control and ultimate transparency of what is going on in this cell because you have built all your plan partners. You know all their fixed costs. You see all of the fees, fixed and variable costs from the stop loss carrier. So you can see all the little bits in between. You now know whether we should be keeping QBE or not, or keeping this stop loss, or keeping this carrier, this plan partner, or whatever, right? And by the way, there's a little like program fee in there. Like that's on the captive. I also get paid. I mean, I'm not paying myself. My clients are in there, but like if someone else were, like I'm getting a little program fee. But you see it, and you can ask about this. Why is this in here? What is this for? That I think for the advisor who's at that stage, understands stop loss, understands their self-funded client, what they need, they'll always know what's going on. They'll know how much they're going to get back in surplus, all that. And I think, again, not for every group, not for every advisor, but for those at that place where I am a little frustrated with the package deals, that's what I'm trying to achieve with this. And, you need a good partner to do it with you that'll manage the captive and stuff. And that's what QBE has been for me, but they get that. And that's probably the most important part is, we can look at it. We can all see it together and look at all the claims and look at what's going on and how many fees went in and out and say, I don't think that this partner is doing a very good job, carrier or otherwise.
So I had somebody reach out to me yesterday, and it was on a level, it wasn't in a captive. It was a level funded program. It was their first year in. It was a group of 14. And I spent an excessive amount of time explaining to him, this is not mature. This is your claims here are still the claims that still counts, even though they haven't been paid by stop loss. It's still showing the activity that's happening on this group. And because he just couldn't understand why it wasn't big. It was like a 9% rate increase. And I'm like, well, you can probably negotiate that, but it's not going to be a decrease. And it's not like there's still risk here. Mm-hmm. You've got run in. They're creating this renewal at about 9 months in. So you're looking at 6 months worth of experience. You can't look at it as if this is a mature 10-year group and these are the claims. And then you have more of a leg to stand on. So I think it's really interesting. Just the discussions and the understanding of, I kid a little bit about stop loss, about how much money they're making and that there's not bigger claims. We know there's bigger claims. I mean, prescriptions are more expensive, procedures are more expensive, but you have to understand the financing of insurance, whether it be fully insured, self-insured, level funded, or through a captive. And if you can't understand that, you're never going to be successful in explaining it to your client and selling it, quite frankly.
We need to have, again, just to top this off, we need to have more leverage.
Yes.
Right. You and I as advisors need to have more leverage. And so if we've got 5, 10, 15 groups, regardless of how many employees they have in one particular cell with one carrier, we now have some leverage to say, we see all the data, we see everything that's going on. I don't think that's quite fair. And if you've got a good reinsurance partner, right, in a captive like this, they're willing to work with you on that too. And if they're not, then you say, beat it. Yeah. But we need more leverage for this, especially for a 14-person group that wants to do a good job and all this. Like they don't have any leverage. Same way in the fully insured world.
Well, unfortunately, one thing I see is smaller groups going into level funded programs because it's less expensive with no understanding of what they're actually doing.
Yeah.
I mean, that's just an aside. So, speaking of smaller groups, Dale, this one's for you. Who is a captive right for? Like, how many employees how many lives, warm beating hearts do you need to have to make it practical?
So I'll share with you that QBE is able to go down to 35 enrolled in the health plan today. That's an area where Aaron's constantly pulling me down and doing the best he can to get to a lower number. And, one day, Aaron, we'll get there. But I'll also kind of open it up to the top end. And let's baby step this. There are employers that are 300, 400 enrolled that are starting to feel uncomfortable with stop loss. They're seeing the no new laser rate caps being pulled. They're seeing that, their increases are still going up, even though the claims don't materialize. There's really only a few tools that an underwriter has, and their manual is just primed with Ozempic and all these terrible specialty drugs. I mean, that's just a horror story that they have in their back pocket. They want to increase that. So a lot of times these mid-market employers are looking for captive solutions, usually with like-minded folks that want to manage the risk down. They might be in the same exact industry. They like to buy together. They like to go to conferences together. Sharing risk just makes sense. It's the next logical explanation to band this together to help for healthcare. So from my perspective, those middle market employers are seeing the value of it as well. They just usually don't want to be stuck in somebody's captive program, which is what Aaron and I are solving for. Then you have the really large employers, let's say 1,000 enrolled. A lot of them are still fully insured, or they are just self-funding and they just feel uncomfortable with the risk. I often find that if I talk to them about their property and casualty risk, they start to see that, hey, maybe I could create my own single parent captive. Maybe this is something where I can have my own insurance company, and maybe I'm taking some risk and placing into a group captive, but I want to take a layer of medical stop loss risk because I can manage that better than the generic pools out there. So that gives you some leverage as well, and a differentiator that could potentially have a long-term client just get really excited about your relationship because you're taking it to the next level.
So what you're saying is there's no real cap on size from the upper standpoint, but on the lower, we're still bottoming out at about 35 to make it practical.
Yeah, and there are solutions that go lower. Aaron, a lot of those solutions, it's just really difficult to feel comfortable just launching off with those small employers because it sometimes turns into death by 1,000 paper cuts. There's no way that you can effectively recoup the losses from a 2-life group that has $1 million claim. That's an area where you need to really prove that your strategy, your stack is working, and then have the risk partner believe it with you. And then you start to go after those smaller groups because what you're doing is actually performing well.
Mm-hmm.
Okay, so I want to go down that rabbit hole just a little bit because, as you all know, I'm very passionate about appropriate solutions for the small group market. Right now, there just aren't very many. I mean, bottom line, there just aren't very many. There's a few that work for some people in some places at some times.
Yep.
But my big concern is that I believe that the ACA plans are starting to enter into a death spiral. So both the small group and the individual. And part of the reason I think that that's happening is because there are people like us trying to do better for our clients, but sometimes we can't. And we're like, okay, well, if things get too bad, you could just go back to the ACA. Yep. So the ACA now plans are becoming a catch-all for bad risks.
Yes.
I lived through this once before here in Washington State with the individual market. Back in the, I think it was in the 90s. Our insurance at the time, you had health screening and 9-month pre-existing condition waiting periods. Well, our insurance commissioner decided that wasn't fair, and she forced all the insurance companies to do away with them. The insurance companies stayed in business for about 9 months, and then they closed the market. So if you were an individual in Washington State and you were not insured, or you had been on a group plan and you lost coverage, you could not buy insurance in our state. You could not buy insurance for 1.5 years. And I remember when the ACA passed, I kept thinking to myself, it's going to eventually get to the same point. I didn't think it would take as long as it did.
Yeah.
But I'm starting to see that accelerate.
Yeah.
And I'm starting to see the water spinning around the drain much faster. How do we protect a market that we need for small employers?
Okay.
Any
So I
thoughts?
see the exact same thing. I see the exact same thing. I really want to help, to Dale's point. I really want to help that 15 life group, that 25 life group. That's like, look, I understand. I think I'm getting this now. And why wouldn't I just be self-funded if I can like have some upside? You know, maybe worst case scenario, I have a kind of a bummer year and I get a 10% increase. That's the same thing I had on my fully insured plan. But now I have a little more transparency and control. And yeah, a little more risk, but I know what I'm stepping into, which are great clients for you and I, right? We groom those clients that way. So they're like, I think I get it now. Once they get there, we want to be able to give them something that you and I trust will actually contain the cost, that is somewhat predictable. And that's been tough. And this is why, like, this captive for me, that's why this exists, for no other reason. It's just to say, if we can all get together with a bunch of 35 life groups and create 1,000 lives because of all of us that are like-minded advisors, now we have some leverage, back to the point before, right? We have all of them under one stop loss carrier, different plans and TPAs and PBMs, certainly, but they're all containing cost about the same. Let's say worst case, you know, maybe they didn't do as good a job as they wanted and everyone got 5% increases, but they saw everything. That would be a much better world. And we'd all be working together to try and say, well, how do we do this better? And how do we do this better? And could we let a 12 life group in now instead of a 35 life group? And we build our lives up. And that's what I'm shooting for. And as I'm pitching this to Dale, basically at QBE too, and like, can we do this? Like, can I do this with you? Can I have control and make sure that I can leave and, you know, all this stuff? And he's like, sure, that's what we do. And there's others out there too, but that's what's been so attractive about this. That's what this project is for me, is to get a bunch of small to mid-sized groups, like your 150 life group, who's starting to get it and say, okay, there's really no downside to this for me. My upside is that I get to share some risk, get some surplus back. But if I want to bail, that's fine. I can bail too. And there's no penalty here.
Yeah.
That's what I think we need to be doing a whole lot more of. We could shift the whole industry could shift. And I think the carriers probably know that anyway, and they would just flip it on a dime and they would do their own kind of thing. But that for me, that's where I'm trying to head with this thing, regardless of the size of the group.
Let me share this quick story. I'm going to look towards my PNC license as well on this one. The Hang Gliding Association of America at one point could not find coverage. You go to the commercial market and it's just impossible to find a quality rate. So eventually creating a captive solution in which you are forcing risk management strategies. There has to be safety classes that the instructors are actually going to. There are checklists that you have to return to the insurance company, and you're doing everything you can to make sure that you are reducing the liability risk of that adventure, hang gliding. And they're able to get that down to 10 cents on the dollar. So that's the power of it. When a market says, hey, this is the number based on what we see, and you say, look, my risk management strategies are better than that. I'm better than that. Let's help people get to a lower price point. Now you've got a lot of opportunity to take over a market. So that is where Aaron is heading.
I love it. Okay. Any last words on captives before we move to the fun part of the show, which you guys don't know about yet?
I don't know.
I'm captive. I'm captive.
Okay. So every podcast I do has 5 burning questions. So since there's 2 of you, there'll be a total of 10. You each get to answer each question. So I'm going to go with Dale first.
Do we get to answer each other's questions?
No, you guys get the same question. You just have to take turns answering. In keeping in theme with the title of this podcast, what's your absolute favorite food in the world, and can you cook it?
Ooh, my wife actually made this last night. She has a baked bean recipe, and it has, chunky bacon in it, different pinto beans, red kidney beans, this whole thing. And it's absolutely to die for. So I entrust her to make that correctly. There is a recipe list. I've never actually tried it to make it on my own, but honestly, it doesn't seem that complicated. I could probably give it a try, but that is probably my favorite recipe that we have in our house.
Interesting. Aaron?
I think you could do it. I've seen him make cereal before, and I'm pretty sure.
My husband's really good at toast.
Yeah. Okay, so I don't know if this is my favorite food of all time, but I've been on for a few years a curry kick. So like at a good Thai restaurant or something like that. I have tried and no, I can't. It's
So like
just never the
yellow
same.
curry, red curry, green curry. What's your favorite?
Yellow, almost always. But there's green, even red I've had, but sometimes it depends on what's in it too. Like I don't need a bunch of mushrooms in there or like fruit. I don't need fruit in there.
I don't need fruit in my curry.
No.
So curry is hard unless you are experienced with spices. Curry is hard to replicate at home because there are so many nuanced flavors in a good curry.
Yes.
So.
Yes. Yeah. The powders and stuff are not quite the same. Yeah. It's that's the joy of going to have someone else cook it, a mom and pop Thai place nearby, or a little Asia town over here in Cleveland to have some good little restaurants.
That sounds amazing. Okay. So since I made Dale answer first last time, you get this one first. You ready?
Okay.
What character trait do you admire most in other people and why?
Yeah. I feel like some people have said this before on your podcast too. But it's just a good one, is humility or humble, of just the humble nature. People like run up against who are like, I'm confident and I really want to do this thing, but I could be wrong. But I really think it's the right thing to do. I can work with those folks.
I like that. I don't think anybody's put it quite that way, so I like it.
Okay.
All right, Dale.
I would say somebody that's just selfless, that won't necessarily just end the conversation if they can't help you any further. Somebody that will actually potentially connect you with a competitor, even just because they know that you have the desire to do something. And if I can't help you, I actually had an email today where there was an advisor asked, hey, what can we do about voluntary captive programs? I can't support you today, but here's somebody that potentially could. Taking to that next step, I think sometimes shows, a quality person.
Yeah. I like that. Okay. So again, we're just doing the little snake back and forth. So you're back up again, Dale. So now I'm going to flip the mirror on you. So what is the quality trait you admire most in yourself and why? What are you most proud of?
What am I most proud of? I would say that I've pretty much thrown just the idea of earning tons and tons of money away in my career. I'm really happy at QBE because I'm not commission based, right? I can just do what I want. I'm passionate about captives, self-funding, employee benefits. And I threw all that away because I just want to throw myself to really help make this community better using captive insurance, just like they're using it on the property and casualty side, but just bringing it into those employee benefit advisor shops because it gives them so much more value. When you have a solution on your store shelf that nobody else can replicate, it's your great value brand. That is so valuable for a lot of advisors. It's just really hard to get there. So if I can just help people, just educate them as much as possible, to a fault, quite honestly, there's some people that hang up on me. They're like, this guy is nuts. But for me, I just educate everybody and just try to give them a better opportunity.
I love that. Okay, Aaron, what is the quality trait in yourself you're most proud of and why?
I do try to be humble. Like I really try to understand I get it wrong plenty. So I try to let people know and have that same attitude. Hope too. Like I'm just a very hopeful person, which is why I've changed jobs a bunch of times to try and get to a point where I feel like I know we can do this. Other people do this. We can do this better. So I'm going to keep at it until we do.
I like that. All right. So this one, either one of you can, if you have two different answers, you can both answer, but I'll let either one of you take this one. So if an employer is interested in exploring medical captives, what's the one piece of advice you would give them?
I'll answer that real quick. Actually have a risk management strategy. That honestly is the most simple, valuable thing that you can find in the captive market. And again, I'm always going to look towards the PNC side. You see these captives that are created where they have risk managers that are plugging in, the best safety protocols. They have the best solution in terms of artificial intelligence, with cameras on all the individuals in the manufacturer's shop to make sure that workers' compensation claims don't skyrocket. Like, you have to have some type of strategy to manage risk. And it can't be just looking towards the network just to solve all of your problems. You've got to work with your third-party administrator, work with your advisor, find solutions that are going to add just more value. And you're essentially driving your future costs by plugging in solutions that you feel, along with your advisor, are going to actually impact cost.
Okay. Anything to add to that one?
No, that's the right answer. Yeah.
Okay. I'm going to just add a quick aside before I go to my last two questions. I work with a number of clients that are more blue collar. So for an example, a trucking company. Whenever I go to do meetings, there's always something on the chalkboard that says we've been X number of days accident free, and they reward their employees for being accident free. Why don't we take that same attitude towards your employees' health?
Yeah. Yeah.
Everybody got in 5,000 steps today, or people are making best choices. Our health care plan is performing well because they're accessing generic drugs instead of name brand. Why don't we have that same visibility?
Okay, so that's a bit of a hypothetical, but I think I do have a partial answer for it, I think. And it's because people are so personal about their healthcare and like whatever journey they're going through. And you so even hear this in friend circles. If you're having dinner, like people may start to talk about healthcare a little bit, but they don't get too into it. And employers just really they want to avoid that conversation. Well, I don't want to know that much about them. You know, I don't want to know. I already know a lot. I don't want to know that much, but you do know a lot. You have their social security number and stuff like in your system. So like, know pretty much, but there is a point where they would and could know everything. They could know all your medical information. And I think they just are hesitant to move to that next extra step of,
My thought on it is, without exposing people, but 100% of people are using in-network providers. 100% are using direct pay contracts. I mean, things like we need to start encourage employers to treat this the same way that they treat their workers' comp insurance or their property and casualty.
I think that's great.
All right.
Now, the one thing I will say is with ERISA, you can't necessarily just give somebody their money back. There are rules around the payroll contributions. But if you receive the check back from the captive or the self-funded plan is performing well, there's nothing really stopping you from just, investing back in them, giving them a better solution, just something that can help make their life easier. That's where you start to see that flywheel of individuals seeing the results and then moving forward with better solutions. That's the world that I gravitate towards.
Yeah. Yeah. All right. Well, sorry for my little aside there, but there's just literally so much to talk about here. Okay. Last two questions. Aaron, you're up.
Okay.
What is your secret talent or something that people would be surprised to learn about you?
Well, talent. I don't know about that. I played water polo in college, which growing up in the Midwest is not common at all. It was a club team. I had a blast. I think the thing that people don't know about me might be kind of interesting, I guess, is that I'm adopted. And so when people find that out, they do have lots of they seem to have a lot of questions. I get more conversations from other people who either are adopting kids or have adopted kids or thinking about adopting. So I always embrace that. But I don't talk about it very much.
I didn't know that.
Yeah.
Didn't know that. So that was good. Dale?
I would say, and this is going back to childhood, but in my family, I'm undefeated in Mario Kart.
Oh, I love that. That's a great answer. That's a great one.
I dominate. And in fact, I'll share this story with you. I actually went back to college about 10 years ago and I visited my fraternity and they had a Nintendo 64 and I said, let's go. And I dominated all of them too. So the crown weighs heavy.
My son used to murder me in Mario Kart, and he does have still has all the old video game systems. He has the different ones. So every once in a while we'll whip out an old Mario game and he kills me. I have not improved, but we still have a great time. All right. Last question. Dale, start with you. Who is the one person, famous or not, living or dead, that you would most like to sit down and have a conversation with, and why?
That's a great question. I'm going to try to avoid the industry just because if I was going to have a conversation with somebody, I mean, this is going to wear my religion on the sleeve, but I'll tell you, Jesus Christ. I just really think just having a candid conversation, just your thought process, hearing, exactly what was going on, zero BC, I think that would just be the best thing I can ask for. So that's my answer.
I love it. Aaron?
Yeah. I was trying to think of this, and I totally blanked on his name, but he's like the father of Stoicism. He was like the leader of the Roman Empire in like 150.
Yeah, I know who you're talking about. I know exactly who you're talking about.
I think that Stoicism stuff, I've been reading more on that the last couple of years and try to digest a little bit of that. Maybe not every day, but I dig that. It would be very interesting to have a conversation and like.
That's Marcus Aurelius.
Yes, thank you.
Sorry, I was going to drive me crazy if I didn't figure it out. So
yes.
Okay, so thank you guys for this discussion. It was very illuminating. I hope a lot of people learned something from it. If advisors, employers, consultants, anybody out there wants to know more, how do they get a hold of you?
I'd say LinkedIn.
Okay.
Yeah, LinkedIn. All my stuff's on LinkedIn. That's a great way. I don't do much other social media, so that would be the best way.
Okay. Well, wonderful. Thank you guys so much for joining me. I appreciate everybody who did join us today. And I'll see everyone. I think I'll see you next week.
Thanks, Nancy.
Thank you, Nancy.
Bye.
Bye.